Okay, how's the sound here? Can everybody hear me okay? Okay. Priyanka, you might be getting a few emails because I'm still getting phone calls of people that are trying to get in here. So, okay, how do I need to shut this off. Okay, let me shut that one and shut my phone, and hopefully they know to call in another phone number. Okay, so sound check is good. Should I get started? Okay, today's class is specifically going to be done on Fibonacci timing. Okay, this is, unlike where I've done the seminars in the past where I've talked about price, and I've talked about the trade setups, and I've talked about the timing, and I've talked about triggers, and people have left so confused that we figured out that we needed to break it down into segments so it will be, easier to get. The PowerPoint should be available. I will make it available to Priyanka, and or there might be somewhere we may end up sending it out with the link of the recording because we will be recorded. But what I want to do now is just get started. And if the questions get too overwhelming, what we'll do is wait until after the first segment and then go over the questions then. Okay, now most analysts that use Fibonacci will only use Fibonacci on the price axis of the market. Okay, but there's the whole other dimension of the time axis, and timing, rather than being something where you're watching a price reversal that would suggest a timing a reversal, we're actually counting the bars between key highs and lows in the market. Okay, so what we're doing is actually using a tool, which I will show you by the end of the presentation. What I'm going to do is start with a PowerPoint and go over some examples. A lot of them are recent. And then also we're going to go and do some current time setups so you can see how it's done, as it occurs. So, as far as the Fibonacci time cycles, I'm using the same ratios that I use to do the price work. So the ones that are used most typically are 0.382, 50%, 618, 786, 100%, 1.272, and 1.618. Okay? What I'm doing on any particular chart is measuring the time between prior highs to highs and projecting forward using those ratios, lows to lows, high to low swings, low to high swings. You'll also measure highs to highs from the intervening lows, lows to lows from the intervening highs, and then last but not least, you'll do alternate time projections, which is where you're comparing swings in the same direction. Okay, it's great for both comparing corrections, because many corrections end up being very similar in time, and that helps you to get involved in the market in the direction of the trend. But it's also good comparing swings in the same direction to see how long a rally or a decline typically lasts in any market. For example, I do have an example in here in the charts that's going to show you that the S&P, the recent swings were like 12 trading days, 14 trading days, another one was 13. So we knew that when we got close to 13 trading days off of the last low that we should start to look for a possible correction developing. I will also go over how to use the dynamic trader, the time projection. I will do that closer to the end, because then this way, if somebody's not interested in that because they don't have the program, then they can move on. Okay, so this first chart is an example in the soybeans, and it's a daily chart. This was the July contract, and this was, relatively recent. It was actually in May. And to give you an idea, what I do with the tool that measures the time cycles is I'll take, or just click on, let's say, a high to a high. So let's say this on the top, we're looking at the March 23rd high to the April 17th high, and then projecting forward in time using, the ratios that I typically use. You won't see all of them here because the chart would be way too cluttered. What happens is I get rid of the cycles that we've already surpassed in time because they don't do you any good as far as predictive, as far as predicting a change in trend, because it's in the past. But in this example, I had a confluence of, let's see, I need to get this little pointer. I had one May 13th, one cycle, a 1272 cycle, May 14th, a 1618 cycle on the 15th, or an alternate time projection where I measured a prior low to high swing and then projected from this low over here on April 27th. And that came in a little bit further out. That came in on the 18th. I also ran the March 30th low to the April 17th high, so this low to high swing, and then projected from the new low at that time, and that came in on the 14th. And then there was also a cycle of the March 30th low to the April 27th low, and 618 in time came in on May 13th. So you really had a healthy grouping of cycles between May 13th through the 18th with a focus on the 13th through the 15th. So we use timing to predict possible reversals, and it would be a reversal of whatever the market's doing into the time window. So in this case, the soybeans were trading straight up. Now, soybeans haven't quite topped yet, unless the last high was the top, but there was a trade that we did get out of this particular setup. So we're looking for a possible intermediate high at this time, and then when that occurs, you want to go down to a lower time frame to see if there's a shift in pattern that suggests that the timing is kicking in. Okay, now when we got to the 15th, we did end up putting in a high on the 15th and started to reverse. Now, it wasn't a huge reversal. The market didn't break down in a big way, but we did get a trade out of it. It just didn't last as long as this may have suggested if it was going to be an intermediate high. So what we did in this case, my next slide should be, okay, this was where we actually went down to a 5-minute chart, and this trade was done. My trading partner did it for us, and basically I wanted to see a shift in pattern to lower lows and lower highs. We did start to see it. I'm not sure where my pointer went, but we did start to see it, and one of the things that I like to do is set up what I call symmetry. So I took one of the prior low to high swings, measured that, projected from the new low, and that gave us a resistance decision where you could fine-tune a short sale, where the risk was, extremely low or relatively low compared to, would you really want to risk to above the high that was made up here? No, but could you risk to just above the 1139.40 area? That's a lot safer trade. So, for example, we ended up, getting short the beans right around this 1139.40 area, and the initial risk was only to just above this 1142 area, which was the prior swing high. Okay, for some reason, oh, here's my pointer. Okay, so here was the price cluster that included symmetry, and then the risk would have been defined as just above this high here, and this is where it was, 1142. Okay, so another example we have here was in the crude oil. Now you will be able to go back over most of these charts because a lot of these examples are on the daily charts, and what I'm doing is just measuring prior high to high swings. Again, what I had on the first slide, lows to lows, alternate time projections. So let's see if I can get this thing going here. All right, in this example, I had the June crude oil, where I took the March 26th high to the April 21st low, and 100% in time of that came in on May 14th. Then I also had another high, January 6th, to the March 26th high, and projected forward 618 in time came in on May 14th. There was a high to low swing that I measured, this April 3rd high to the April 21st low, 1618 in time came in on May 15th. There was a low to low cycle that was December 24th low to the February 19th low, 1618 in time forward was May 15th. And then an alternate time projection where I had the February 19th low to this March 26th high, and then I projected it from the April 21st low. Oh, actually that one's off the chart, so that one did not belong in that cluster. But you can see that you have a confluence of timing relationships that come together within a relatively tight range. I'm starting with these examples on the PowerPoint first so you can get an idea of what we're trying to accomplish, but then we're going to go to the actual charts and go over these. All you're doing is picking the key highs and lows, and some of them, these are obvious to me, but they may not necessarily be obvious to you. But you want to, the standout pivotal highs and lows are the ones that you want to mark off and run the cycles from. There also has to be, enough time in between these swings so that when you run the timing cycles, it's not, if you ran a swing high to high that was only 10 trading bars and you used all the cycles, you're going to have a timing cycle come in, almost every single bar. So that has no value. But if you have a swing that's 40 trading bars from the high to high, and then you multiply that by the cycles and project forward, then you'll definitely have it spaced out, and you'll also see the overlap. So in this example, okay, we'll go over the nuances after I get the first part of the presentation done, because then we'll go into more dynamic questions and answers when I actually do the work on the dynamic trader. So here you can see the confluence of the 4 dates between the 14th and 15th. If crude oil, or since crude oil was going straight up at the time, we were going to look for a possible high. So, if you were long the market, you would know that you needed to tighten up your stops and to look for a possible reversal. So in this next chart, okay, this does show you the reversal. We did have there it is. The actual high was made just prior to the dates. Okay, and sometimes you will see this happen, and I did want to use an example that wasn't perfect hit because the high was not actually made, on the 14th or 13th. It was made on the 12th. but we did know that we had the timing considerations that were coming in for the possible reversal. So all you want to do at that point is go down to, for example, a 15-minute chart and look for a shift in pattern to lower lows and lower highs. That will tell you that this timing is worth looking at as far as setting up a trade. Okay, we did see, let's see, that high was made at $60, and I know that we did trade down at least to 56. So that was a $4 decline that was warned of by just running these cycles of the prior highs to highs, lows to lows, and and so on. So that's what we're that's what we're working on. And then we'll go live to the current markets as soon as I finish the PowerPoint. Okay, I'm actually going to have to do the questions after this. This is only about 24 slides, and then we'll do the questions. This next chart is S&P cash, and what I'm doing here is actually just doing the time counts. One of the things that I like about Dynamic Trader, which is the software that I use, is it allows me to label the highs and lows and look at how many bars and how much price is in between these. Okay, so I like to compare swings, corrective swings, and also trend swings, and see if they're similar. So in this example, or one of the reasons why we had a time window right around May 8th before the market dropped about 50 points in the S&P was because of these time counts. I had a 39 trading day rally over on the left-hand side. Hopefully the pointer does show, up into the October 11th high. Then I had a 44 trading day rally, low to high. Let's see, 19 bars, that really wasn't similar. And then as we started rallying off of the March 6th low, which also was suggested by some of these time counts, 44 trading days brought you into May 8th. So that's what one of the time cycles was. It was an alternate time projection of this prior swing over here, which was a 44-day trading day rally. Okay? So that projected helped us to know that we were probably going to see a reversal in the S&P. We did. It wasn't a major high. I believe it was about 50 points on the downside. Okay, but that kind of information, as far as the timing work, will help you in your trading. As far as on the way down, now look at these other measurements. We had, let's see, a 39 trading day decline into the July low. There was a 43 trading day decline into the October of 08 low. And then there was a 41 trading day decline, which wasn't exactly the same as these other prior swings, but once you were looking at a swing that was similar, that was one of the reasons that we were looking for a low in March. At that time, because of one of the time projections, along with the fact that the market had extended into or from the prior low to high swing. Okay, that 1272 extension was basically the minimum target that we were looking for off of that last high. And once we had met that target and then also started hitting some of these timing parameters, we knew to watch for a possible intermediate low in March. So timing actually did catch this low. You can go back over the, if you get the end of day newsletter, you can go back and go to the archives and look and see what was there, because we did have timing. All right, I'm going to go over, let's see, this is an example, and this is what you can try and recreate, because I will make the PowerPoint available. this is where we had the timing for the high right around May 5th through May 8th. Okay, so what I had was a high to low cycle, or the January 28th high to the March 6th low. 1618 in time came in on May 6th. I had that alternate time projection, which I showed you on the prior chart with the time count. So it was the March 17th low to the May 19th high, and it was projected from the March 6th low. That gave you the 100% alternate time projection on May 8th. Then I also measured the January 6th high to the March 6th low, and we had 100% in time came in on May 5th. There was also a low to a low swing, so it was the January 20th low to the March 6th low. 1272 came in on May 5th, and then also the November 21st low to the March 6th low. 618 in time came in on May 7th. So with a confluence of 5 time relationships that were coming, due between the 5th through the 8th, that's when we started looking for a reversal on the 15-minute charts to tell us to start playing the short side. Now, ultimately, we never broke the support. We did get, I think that was something like the 50 or 60 point decline in the S&P that was tradable because we had, we had setups in the room. But then once we ended up holding, we eventually took out that last timing high. All right, this next example is in the S&P. This is actually, recently. This is the September contract. And again, I'll start taking the questions just after I get through these initial slides, and then we'll go from there. But here, what I did was I measured the swings in the same direction. The first low to high swing from the March 6th low to the March 26th high lasted 14 trading days. The next swing from low to high was 13 trading days, very similar. Okay? So if you, for example, ran the alternate time projection of the first swing up from the next low, you would have known to watch for a possible reversal right around this time window, or where it was projecting 14 days forward plus or minus a day. Next swing up was 12 trading days. And then the last one into the June 5th high, which we haven't taken out yet, 13 trading days. Okay, so this is symmetry in time, similarity or equality. So it's equality where 13 days equals 13 days. It's similarity when you're comparing 12 to 13. Okay, so it's time symmetry. That is one of the tools that you can also use. All right, this is an example in the, I'm going to use an example that didn't work initially because, hey, you have to be prepared for that also in the market. This general pattern that started from the March 11th low in the pound, or once you took out this prior swing high here in March, then you're looking at higher highs and higher lows. So what I wanted to do at that point was set up the buy side. So I did the price analysis here, and I also ran a timing histogram in the program that I used and projected for a possible low. So time and price came together, and I thought this was a great opportunity for a buy in the British pound. Now there was one buy entry that occurred, and it gave the market a little bit of a bounce, and then it was stopped out. Okay, but because there were still both time and price parameters that were not violated, we still had to look for a possible reversal at this time. Okay, so this is breaking down this chart even further. This is the daily chart in the British pound. And there was still support left here in this market. And what was interesting about it was after you would have gotten knocked out, after you did have a nice reversal here, I think it was a couple hundred points in the pound off of that higher support that came in just above it. But then what we were looking at here was a decline that was 670 points in the pound. That compared to the next decline, which was also 670 points, and it was also in 4 trading days. So here's time symmetry, the 4 trading days and the 4 trading days, and price symmetry. And we have gone way beyond what I showed at the time of the snapshot here, because that was a 955 point rally off of time and price considerations, and it had gone even further at that point, or after this. All right, this next example is in the Japanese yen. This will give you an idea of what I'm going to show you at the end of the presentation. I don't want to start with the dynamic time projection tool that I use. This is where I basically tell the program which highs and lows to use to run the time projections, and then I will project, put out the report button on Dynamic Trader, and it will show me graphically where there's a clustering of time cycles. So as I was doing the analysis in the yen, and the larger pattern was bearish. You're looking at this pattern of lower lows and lower highs. The time projection came in right around the end of April for a possible high as the yen was rallying into it. And as it hit price and time came together, we did see a nice, healthy reversal at this time. Okay, again, I'm giving you the background of what everything's going to look like once I show you in the program as soon as I finish the slides. Okay, now typically when you have a timing reversal, you're also going to look for a target ideally of 1272 of the swing. But because we don't always get the target, what you do want to do is trail your stop down. So let's say because we hit time and price resistance and the market did start to roll over, once it stopped going down, you need to exit the trade. You cannot assume that you're always going to get the target. This next chart shows you that in the yen we did not get the target, okay, which was that 97.05 area, but there was a 439 point decline. Okay, so even though we didn't get the major target like we did in the case of the British pound, this was still a very healthy trade that was defined with the help of timing. It's a dimension that many other analysts do not use. Okay, let's see. There is another example in the Japanese yen. This was recent, and again, the reason why I'm using more recent examples on the daily charts is so you can go back and actually attempt to recreate this work. So I will make the PowerPoint available, and the recording will probably be ready in about a week from now. You'll be able to go back over it. But meanwhile, if you have any of the tools on, let's see, you will not have all the timing tools on TradeStation, and you will not have all the timing tools on eSignal. You would have it on this program, you would have it on Fibonacci Trader. I believe Genesis may have it, an alternate time projection tool, and there's probably a few other programs. Okay, so in this example, we had a really healthy confluence of timing cycles that came together May 20th. Yeah, it looks like May 20th through May 21st. There was a high to low cycle. Okay, it was the January 21st high to the April 6th low, and I consider this one of the most powerful cycles in this whole setup. The high to the low of the prior larger swing, 618 in time, came in on May 21st. Okay, so that because it was of the major swing and because it was the 618 ratio, which I find to be, pretty powerful. It's more powerful than, a 382 or a 50%. So because of that, I was definitely looking for a possible high in the yen. There was another cycle of the March 19th high to the April 28th high. 618 in time came in on the 21st. Then I measured, March 19th high to the April 6th low. And 2618 in time, which I consider a confirming cycle, came in on the 20th. I also looked for a confirming cycle using the smaller swing. The April 28th high to the May 7th low, 1272, came in on the 20th. And then there was an, alternate time projection where I measured the March 5th low to the March 19th high, projected from the May 7th low. 100% in time came in on the 21st. So again, you're looking for a confluence of time cycles. You had 5 of them that came in between the 20th and the 21st. And since the yen was trading higher, you would look for a reversal to back down. Okay, and what happened here was the actual high was made one day later. It was made on May 22nd. There was price resistance that overlapped this timing. Ideally, you want to see price and time come together, though I am focusing on timing only today. But just to show you how it all comes together. And you had a, it looks like a move from 106.57 down to at least 102.95. And that was with that confluence of time cycles that came together. Okay, so do you kind of see how you might want to be able to do this on your own? And I know that some of you are a little bit confused, but I am going to go back to showing you the basics from blank charts as if you were sitting there and doing it yourself. So once I get finished with these slides, we'll do that. Okay, this was a fun setup. This was actually in coffee. Now, I just started doing some of the coffee markets for, for Denise, and started looking at some of the other the other markets like sugar and cocoa, and there's definitely going to be some opportunities in some of these other markets. And all I did here was use the timing histogram, which I will get into. We'll go over some examples towards the end here. And I projected from one of the last lows in coffee, because the coffee was going straight up. So what you wanted to figure out at that point was, Well, if the coffee's straight up, when might the move terminate? You're going to want to know that if you're long the market, and you're going to want to know that if you want to short the market. Okay? I mean, you should all want to know when you're going to have a reversal. We actually hit some very important resistance. If anybody's not familiar with Twitter, I do post charts, usually once or twice a day on it. And I had this example up in the coffee. And then this is what occurred. So you made the high again in time and price. We had a healthy timing cluster that you saw on the prior chart, sorry. And we also had the price resistance. So I know that one of my guys in the room that actually trades the softs, he was short and kept the position because of the timing. Okay, let's see. This is an example of where we're currently at in the S&P cash, and there are two time windows that came in relatively close to each other in the S&P cash. Okay, and again, you can see from let's see, the highs and lows that that are identified by the swing file, the lines that are coming through the bars here. Those are really the highs and lows that I want to use for the price analysis. As far as choosing the highs and lows, that can take a little work because it can be subjective. I mean, sometimes it's really obvious the key pivotal highs and lows in a market, and sometimes it's not. So there are times where I actually have to sit down with somebody and point out the highs and lows until they get the general idea of what swings they should be picking and what makes sense as far as the timing work. So we will get to that when I do it off the dynamic trader. But what you want to know here is that I measured let's see, I used the January 6th high, the March 6th low. I used these little swings here, the let's see, April 21st low to the May 8th high, May 15th low. They may not be extremely obvious because this data is kind of squished up on this chart. But if you were looking at less bars, you would see these as obvious swings to run the analysis off of. And what we're looking at currently as far as the stock index is we initially had a high that was made within the first time window, June 4th, 5th. Market rolled over slightly, but was unable to take out key daily support. And then the next one, which we're on top of right here, right now, and that's between June 9th, June 12th. And so far, the high's intact. On the actual futures contract, the high is still the June 5th high. But in the S&P cash, we did make a slight new high on the 11th. Okay, so I'm considering this high pivotal. And we're looking at the 15-minute charts every day to see if the market breaks down and suggests that this timing is worth something. You can use this on all time frames, but I would not suggest doing anything too much lower than a 15-minute chart. That's what I do in the chat room. As far as the intraday charts, I like to look at a 45-minute chart because it breaks down equally into the trading day, and also a 15-minute chart. And I've also started playing with the Globex data. And if I look at the Globex data, I'm trying to look at a 120-minute chart to see if there's some value there. I don't have enough data on it at this point to know quite how well it works. The work on the daily chart, you don't have to worry about the Globex data messing you up. With the daily charts, I do include the Globex, highs and lows. let's take a look at. And also this is just an example of the timing histogram that I used in Dynamic Trader. And here, again, the bonds have been straight down, and when I run a projection that shows a confluence of, you know, many time cycles coming together in a relatively tight range, it will give me this visual on the chart, and then I start looking for buy signals. Now you're obviously going to be going straight down into this zone. So what you ideally want to do is, in the chat room I use a 15-minute chart, and I wait to see a shift to higher highs and higher lows. You could use a 5-minute chart if you want. You know, you just want to see a pattern shift and a justification for using this timing. But we had both hit an important price projection down here, or within a tick, and then we had this standout timing bar. And I will show you the updated chart as soon as I get to opening the program. But we did have a nice healthy rally. If anybody was watching the bonds, you know that you know, the bond had a nice rally off of this time window. You can use tick charts if you want, but if you're trying to call an intermediate high on a daily chart, a tick chart may give you a whole lot of false entries. If you are trying to call a reversal off of a 15-minute timing setup, then a tick chart's more appropriate. Okay, actually, I went in and gave you an example. This occurred just a few days ago in the bond. So you know that we had that time window. So this was actually a 10-minute chart, and I wanted to look for something that suggested that timing was worth something. And when I saw the market take out a prior swing high, that was the first opportunity for me to set up the buy side. Okay, so I took this prior high to low swing, which was 13 points projected from the next high, and that gave you, you know, the symmetry projection for possible support. And then I also ran the retracements of the low to the high, and the symmetry projection really pretty much overlapped that 618 retracement. So that was the zone to look for a buy entry. And then there was probably one more opportunity here on another pullback, but this is what the bond eventually did, and the timing was, you know, the catalyst to get you to go down to the lower time frame and watch for a reversal with that timing in mind. Okay, all right, that's it for those examples. The rest of the work that we're going to do is going to be current markets. But these next couple of slides are just going to show you the tool, you know, that you would use, well, in my program, or you can use in, let's say, in TradeStation, for example. You do have a tool that will measure prior highs to highs, lows to lows, highs to lows, and lows to highs. But from what I understand, you do not have a three-pointed tool. So you can't do these other timing projections on that program unless, I think there's a way where you might be able to just, you know, draw a line, and you might be able to do, you know, an alternate time projection by just, you know, taking the, you know, the measured line and then moving the line over. Okay, but I would rather have tools, you know, that are really going to, you know, help you get the job done here. So the timing tools that I use, there's only two in the program. The first one is where you're measuring using the 2 points. Okay, so again, the high to high, you can measure prior low to low, high to low swings, and low to high swings. Okay, so you'll do all of those with one tool. Then you need also the three-pointed tool, which I know that you have on DT, but you also have it on Fibonacci Trader, and I believe there was a tool, because I worked with NinjaTrader and I also worked with Genesis in getting a tool from using 3 points. The other programs, I don't know. I don't use them. I don't have them, and I'm not really sure what's available. The three-pointed tool, that's where you're going to measure prior low to high swings projected from another low. You know, that's where you're comparing swings in the same direction. That's the tool that I used when I was looking at the rally swings in the S&P, where, for example, you know, one of the prior low to high swings was 13 trading bars, and then another one was very similar at 12 trading bars. Okay? But the alternate time projection that I made from using the three-pointed tool was what gave you a heads up to, you know, a tradable high. And then you can also run with the three-pointed tool the highs to lows projected from another high, again comparing swings in the same direction. And then you can also measure, and I don't use this or need this as much, but I do look at it if it's obvious. But you can take a prior high-to-high swing in time and then project forward from the intervening low, or you can measure a low-to-low swing. So let's say there was a low-to-low that was 50 trading bars, and then project from the intervening high between those two lows and project forward, and also, you know, look for a possible change in trend there. Now, as far as running the time cycles, what you're looking for more often than not is a confluence of cycles that come together. Okay, so you're going to want to see ideally 3 or more cycles that come together within, you know, a relatively tight range in time. So when we had dates, like let's say between May 5th, May 8th, that's, you know, within a relatively tight time window. You can't say I'm expecting a high from May 10th through May 20th. That's a little bit too wide. Okay. Now also, anybody who has read my book, you know that this is all spelled out in there. Okay. If has anybody already read that and worked with those chapters on timing? Okay. All right. Good. I mean, I know that, you know, everybody's at slightly different levels here. You know, some people are probably, you know, just beginning to look at Fibonacci timing, and, you know, and other people, you know, have the same program that I have, and they know how to do it. Okay, but bear with me, and I'll try to you know, get to everybody. I just want to give you an example of or what my timing tool looks like, and the ratios that should be selected. Serena, you might get so many lines because you might be doing just like smaller swings. I mean, if you do a high to a high that's 10 bars, you're going to get a line, you know, every other bar. You know, you need to have larger swings, or you need to lower your time frame. Right, so in the dynamic trader program, this is the only one I can address because this is what I have in front of you. The ratios that I choose for the time projections using 2 dates, 382, 50%, 618, 786, 100%, 1272, 1618, and 2618. So that's what you would have selected on the tool that uses 2 dates. That's the one that almost all programs have. The tool that a lot of these programs don't have is the one where you're doing time projections using 3 dates. Okay? And as far as that tool, I'm just using 3 ratios there. I'm using 100%, 1.272, and 1.618. I guess in a perfect world you'd put the 1272 over the 1618, but you know, it doesn't matter because it comes out the same on the chart. But those are the three ratios that I would use when I'm running, you know, the alternate time projections. Okay. All right. Those are the tools. I gave you some examples of what can be accomplished, but now what we'll do is we'll get down to the charts and start going over some actual examples. We'll talk about, you know, why, or, you know, which highs and lows that I'm going to choose for the analysis, and then hopefully that will address some of the questions that have been asked, you know, during this time period. I can stay and answer some questions now before we do a little bit of a break, because then I need to open my program and get the chart set up for you. So I see one question so far. What's the maximum and minimum time frame? Well, I typically focus on the daily charts, you know, for the bigger picture. Occasionally I will look at a weekly chart, but not that often. I generally don't need to, you know, go that far out. And then the lowest time frame that's reasonable for me to do the work on during the trading day is 15 minutes. I've goofed around with it lower than that just to see if it worked, but it's too much work. I will go over how to use the timing histogram in DT, yes. And as a matter of fact, I will give you, if you email me, I will give you my timing template. So I'll do that. The abbreviations, TCR. TCR is time cycle ratio. That is coined by Robert Miner in his program, and it's the tool that you use two dates from. And then the ATP stands for alternate time projection, you know, because you're using 3 points, and it's you know, alternate swings that you're comparing. As far as e-signal, don't go away, Albert, because we got another 2 hours after break. But as far as e-signal, they don't really have a timing histogram at all. I think the only thing that they have is a tool from 2 points. So you'd be able to do the time projections of highs to highs, lows to lows, lows to highs, and highs to lows. But you would be limited to that. You wouldn't be able to do the ones that I have, you know, on the bottom of that page. It's not available. Okay, let's see. Oh, okay, you want to see let me show you the 2 dates, the previous slide. Okay, here's the time projection tool where you do the time cycle ratios on Dynamic Trader. This is using, you know, the 2 dates or the 2 points. TOS, I don't know what TOS is. Third-party vendors. NinjaTrader, I actually worked with NinjaTrader, and I think that the tools are there. You should have those tools. The only issue with that is, do you have enough data within NinjaTrader to do the analysis? Oh, Thinkorswim. I'm not familiar with that platform or, you know, program, so I can't tell you. You'd have to call Thinkorswim and ask them what they have as far as Fibonacci timing tools. Okay, RB, let's see, how do I deal with multiple touches of a swing point, the first one or the last one? That can be difficult because it can really skew, you know, if there's, like, let's say, sometimes I've seen it where you've had 3 tests of a level and they're all the same price. So which one do you take? Well, sometimes I'll just take the one in the middle. I think that there's a default in the program to take the second one or the last one. I think that's the way Bob Miner had it set up. But sometimes I'll just run it both ways, or just keep in mind that you want to give it a little bit of a wiggle room and say, well, don't really know if it should be run from, you know, the first low or the second low, and just give it a little wiggle room as far as, you know, looking at the time. It's not always perfect, you know, as far as this work is concerned. If the chart is sloppy, it can be difficult. Now, the other thing that you can do is you can look at another chart in the series. Like, let's say if it's not clear where the higher, or, you know, if it was the same exact high, maybe go to the cash and look and see if the cash gives you one that's higher than the other, and then use that. You know, that's what I've done sometimes, because sometimes the futures contracts, you know, don't all you know, trade that well together. Okay, let's see. I'm going to try and scroll back and see what other questions that I haven't dealt with. Well, you know what? If there's a question that you want answered now about the presentation or what I'm going to do, go ahead and ask it. And then when we're done, we'll take the break and I'll go get Dynamic Trader set up. As far as the intraday time frames, I've been using in my chat room for I'm thinking I'm going on 7 years. I keep on trying to, you know, not remember how long I've been doing this stuff. I basically started in on Wall Street as a teenager in I think around 78. But as far as this work is concerned, I've been doing it in a chat room where I've been presenting it for about 7 years. And I've been using the 15-minute charts, the 45-minute charts, and that does not include the Globex data. And then I use the daily charts, but on the daily charts I do include the Globex data. The PowerPoint will be available for download. I will make it available. Let's see. Why do I use candles? You know what? There are a lot of times where I don't use the candles. I think a lot of my traders have preferred it, and sometimes I will keep the candles up for them so you can kind of, you know, see when some reversals might be taking place. But when I'm doing the analysis on some of the lower time frame charts, I actually have to keep it in bars so that I could see where, you know, the actual highs and lows are coming in, because sometimes it's hard to see with the candles. 3-minute charts you can use for a trigger, but that would be to a higher time frame than the 3-minute. But if, for example, we had a setup in the chat room that's on the 3-minute chart, you would use a tick chart for a trigger, because by the time you got a trigger on a 3-minute chart, the trade would be over. So you typically need to go to a lower time frame. Yeah, not 1 year. It's yeah, the chat room I've been doing for quite some time. I know I started doing that originally, I think, with tradingmarkets.com, and then just kept doing it. Okay, any more questions for now, or I prefer 15-minute setups, but the 3-minute helps fine-tune an entry. You can either wait for the 3-minute chart to, let's say, break symmetry, which that's not what we're teaching here today, but to break that, and then you buy the next pullback. It's like some of the free videos that I put out on the site. If you go to my website and just click on the free video link, I've got quite a few videos that, you know, is on the entries. You cannot use tick charts for timing, because the timing is not going to make sense. You can do price work on a tick chart if you want, but you need to have equal measurements of time, and you're not going to have that on a tick chart because it's not based on time.